All right, welcome to the conversation on the Young Turks. Great guest for you guys, Nomi Prins. She is a former managing director at Goldman Sachs, but don't worry, she's a good guy. She's been on the Young Turks many times, one of the top experts in the country on these financial issues in the Federal Reserve. She's written Collusion, How Central Bankers Rig the World, and It Takes a Pillage. Nomi, great to have you back on. Who is benefiting the most from these bailouts so far? Big business or small business?
Definitely big business on the win for themselves versus smaller businesses and individuals. And they've had help by the bailouts that have been structured through the stimulus packages from Congress, as well as from the Federal Reserve, as well as from the Treasury Department, i.e. Steve Mnuchin, former foreclosure king and Goldman Sachs partner, who is in the middle of all of that, having negotiated, I think, a really, really sweet deal for Wall Street banks, for major corporations, but particularly for Wall Street banks, actually, even though, they should be lending out money anyway because that's their job. But they're actually getting propped up by multiple different ways from the Federal Reserve, the Treasury Department, i.e. the taxpayer, and even the stimulus package.
Why the banks? Why is it going to the banks?
So there is a portion going to small businesses, but it's going through bank portals, right? So banks get allocated money from the SBA loan program, and they then parcel it out to, first and foremost, their ongoing clients. So, for example, JP Morgan Chase, Citigroup, Bank of America, even Wells Fargo, and they have ongoing relationships with people, loans that they've given them, say, in the past. And based on them already being clients, they sort of get an easier treatment in terms of getting SBA loans. Now, that's not necessarily a bad thing because these are individuals who could use those loans and may get those loans. But the process is really mired in red tape. And having that relationship to begin with means that the people that don't have a relationship to begin with the bank from whom they've already gotten loans has a much harder time getting a chunk of those loans. But there's more to that. On the other side of the actual loans, which was about a $260 billion out of a $2.2 trillion stimulus package, there's what the Fed did most recently, which is the Fed decided that they would actually encourage the banks who are part of the SBA loan program to lend under the SBA loan program, under the stimulus package, by offering to buy the loans that the banks make with money that isn't theirs because it comes through the loan program, and buy them and basically pay the banks for the loans they've just made to people during this process, for which the banks are also getting a 5% fee. So there's all these little cutouts that happen that are part of the sort of the main orchestration of that package. And then the bigger numbers, part of the stimulus package was about $500 billion worth of money from the Treasury Department to corporations through the Fed. What the Fed does is take that money, multiplies it by sort of Fed magic, and then that money can be used to the tune of $4.5 trillion to $5 trillion to lend out to big corporations. So what looked like a $2.2 trillion package is actually somewhere like a $6.5 trillion package, with most of it going through the Fed to companies and to banks that are involved with those companies and with the Small Business Association loans.
Small business part I get, and there's actually some logic to it. The reason they're using the banks is because they want to make the process quicker. If you go apply to the government doesn't have infrastructure for loans, it's more difficult. It'll take a longer period of time. So they incentivize the banks with a certain interest rates and certain percentages, et cetera. I get it. And that actually does get to the small businesses. So far, not that bad. Now, when we turn to the big businesses, then it becomes this black box, and all the rest of us lose track of it. So there's a much bigger piece of the pie going to big businesses. So is it the same concept? The banks get 5% and then loan the money to multinational corporations, or is it different?
One is, yes, through the sort of stimulus package, that $500 billion gets multiplied at the Fed into lots of more money. And that money then goes through banks to those big corporations. So they're still going through whoever their banks are, but it's money that's been multiplied under that corporate process and going through banks, sort of like small people. But for small people and small businesses, that money isn't multiplied to that kind of effect. So it has a larger multiplication factor for the big businesses. And the other thing the Fed's also doing is loans that are already outstanding from those same big businesses, bonds that are already outstanding, debt they've already taken out that they have to repay, but they can't repay right now because they don't have as much money coming in. The Fed is buying the debt from those corporations as well and just kind of holding it. And we're financing part of that hold. So part of the stimulus package is saying, for example, and this is just one of many, the Fed has many programs. We don't have time to talk about all of them, but just let's talk about one that buys the debt of these big corporations. It's just one of them. So basically, the Treasury Department gives the Fed $10 billion, and the Fed turns that into sort of 10 times that. And then it basically allows banks to lend that money to corporations, or it buys those corporations' debt. So now it's holding the debt. The corporations don't have to worry about it because they've received money for that debt. And then they go and borrow more under another program in order to keep themselves afloat. So it's like they have multiple ways of tapping into the well.
What does it mean that the Fed multiplies the money?
They receive a piece of money, in one case from the Treasury Department. And because they're the Fed, they're able to say, all right, well, that money it's like collateral for, like, it's almost like a loan to themselves in a way, where they basically borrow money that they create, they electronically create, and they use that money to buy bonds, to buy debt of corporations or banks or so forth. And then they keep those bonds back on their books. So it's like the seed money acts as collateral for them to grow or to leverage that money into a larger amount. And then they use that larger amount to go back and do the same thing multiple times. Where do they get that money from? They literally just create it out of like electronic movements. And then they have a balance sheet of their own. And that balance sheet right now, it's about $6 trillion worth of bonds they've bought, about $2 trillion of which they've just bought in the last few weeks. So they're basically just expanding their own ability to create money. And somewhere beneath all that money, there's a little bit of real money. That real money is coming from the Treasury Department, i.e. the taxpayer. What they're creating off of it, again, is sort of electronic.
Because I heard that they, during 2008, oh, don't worry, the banks paid everything back when the American government actually made money from it. But are they referring to the Treasury, or are they talking to the Fed? Talking about the Fed? Did the Fed sell back any of that stuff?
So when we hear about how the banks paid back with interest the money they were, given by the federal government, yes, there was a pot of $700 billion, which was created by the Emergency Stabilization Act, which created TARP. And they used that money to sort of dole out to different banks to make them whole on bad assets they created and bad credit derivatives bets that they made. And at some point, those were repaid. Now, why were they repaid? Because that's the really good question. They were repaid because the banks that basically got the money from the Treasury Department, from the government, from us, got money from the Fed in order to repay that money. So it's not like rocket science that if somebody gives you money to repay something else to someone else, that you look really good in the process. It's not your money. The money came from the Fed. The banks don't repay the Fed. That's why, towards the end of your question, that's why the Fed has multiple trillions of dollars of assets still left on its books. And that's why under this crisis 2.0, the Fed is increasing the size of its books and the money it's creating to give to banks for their assets.
So we got a toxic asset that the bank created. And back in the day, it was because they bet on housing. And those are bad bets. There were bad mortgages in there, and they bundled them together, and that asset was going to blow up. Now, we have some of that today, too, in a different context, but that's easier to understand because a lot of people have heard about that, right? So the bank has that. Normally, it would blow up in their account, and when they went to go sell it, if it was worth, let's keep it easy, if it was worth $100, it's now worth maybe $40. Uh-oh, they lost $60 and they're in a lot of trouble, right?
Right.
But instead, they sold it to the Fed.
Right.
Now, when they sell it to the Fed, who determines how much they pay for it? Do they pay the $100 that the bank was claiming, or do they pay the $40 that it's actually worth?
They pay the $100. So
of course.
it's up. I mean, like, and they did during the subprime crisis, and that's what they're doing now. And during the subprime crisis, the idea that why they did that was because, well, we didn't have time. Things were in crisis. Things needed to move. Liquidity needed to get back into the system. Markets were going to die. People weren't going to be able to get money out of ATMs. It's not dissimilar now, except they're not even bothering to sort of go through that rhetoric. Now it's just like, this is what's going to happen. And so banks, especially now that the Fed can buy not just, then it was toxic mortgages, now it's toxic corporate loans and other things. Literally any other kind of financial asset, just period, the banks have almost, they can now buy in the same manner.
And my guess is people don't sell them valuable things that they're going to make a profit off of. They sell them or unload on them the worst garbage they have.
That's right.
Because they want to get rid of it. What's stopping them from buying $60 trillion worth
Nothing.
of junk?
Literally nothing. I mean, nothing was stopping them last financial crisis, except for at some point, sort of there was other games in town, right? So at some point, banks, companies, the stock market, it was all sort of working enough that the Fed didn't have to buy as much at those prices because they could get those prices in the market. One of the reasons they could get some of the prices in the market that were higher is because the Fed already kind of created this sort of artificial value of what their stuff was worth to begin with. But at some point, that artificial value became, for banks and companies, the market value.
The main problem, right, is if they print too much money, or these days electronic movements, then presumably inflation is going to go up. Is that the main issue?
Inflation goes up anyway because they're buying all these, at some point, inflation of stock, inflation of the value of debt that shouldn't have that value. The whole idea of what prices should be get totally out of whack for any financial security. Like everything just is valued at much higher than it should be. And so there's an element of inflation there, but it's for those particular assets. Inflation has happened. Like before even this crisis, this component of what I think has been a crisis since the financial crisis of 2008 happened. There was already inflation in everything that everyday people need to use in their real lives. There was inflation in rents. There's inflation in education. There's inflation, obviously, in healthcare. There's inflation in medical supply. There's inflation in so many places because a lot of money was going into markets as opposed to going into like really building things and creating a sort of more foundationally sound economy. So there is a worry of inflation. But inflation in terms of real like economic growth doesn't happen because of these movements. It doesn't happen because these movements are fictitious. If you're creating money out of thin air and buying stuff with it, it doesn't really value the foundation of the economy. It just sort of values the financial assets that it goes after.
Anderson Cooper has asked Bernie Sanders approximately 3,000 times, how are you going to pay for that? So let's take student debt because that's an easy one because it's also debt. If they wanted to, instead of buying toxic assets from the banks and just putting it on their balance sheet, could the Federal Reserve take the $1.4 trillion of student debt and just buy it?
They absolutely could, because they would basically, through the same process, they would basically create some money, say seeded by the Treasury Department, if the Treasury Department wanted to get involved, inflate that amount of money, sort of electronically create more, and buy up those loans, and then the payments from those loans would basically go to the Fed at some point in the future, but the students would be made whole.
Who the hell is the Fed? Because they're not individuals in running their own business, or they're human beings, but they're not doing it for themselves, right? They're not businesses. They're not the government. Who are they?
They're a bunch of people that are approved by the government, selected by the president, to effectively, their MO is supposedly maintain stability in the markets, and then create a good employment situation, keep inflation low, and all these things that are in their mandate. But the reality is, the Fed was created by the banks back in the early 1900s. The Federal Reserve Act was passed in 1913, but even up until that year, by banks who were concerned that when there was a recession, or if there was a problem, or if there was a run on banks, or a liquidity issue for banks, that they had nowhere to go besides the Treasury Department. If the Treasury Department couldn't back them, they needed someone else to back them that didn't have to get an okay from the Treasury Department. That's ultimately how the Federal Reserve, which is the sort of bank, it's a central bank. It's the big bank that's there, and that's why and how it was created, to lend money to banks when they're having problems. Now, banks are members of the Federal Reserve. So it's like they're lending money to their own members when their own members have problems. And those members at the time it was created were supposed to put in money sort of on reserve. That's why it's called the Federal Reserve. They're supposed to reserve money into this entity that is selected by the government but is supposed to operate independently, and reserve that money there. But over time, what's happened, and certainly most recently, is the Fed just creates money rather than uses that reserve to help the banks when they have problems.
So, of course, when they go to buy a couple of $1 trillion worth of assets, they're not going to buy your moped. They're
Right.
going to buy that toxic assets of the banks, because the people making the decision are the heads of the banks. Okay, so Nomi, it's super important now to talk about how is this going to go wrong?
We saw what just went wrong, right? And which is that they printed about $4.5 trillion into the coronavirus crisis, and now they're printing more. What we saw was that no matter how much they printed the last crisis around, when a problem arose, and it was a problem that some people thought was coming, some people didn't know, but when something that acute happened externally to the financial system that impacted the financial system, people on the bottom of that system, individuals, small businesses, people that aren't even sort of counted in that, are the ones that most get hurt. The markets, yes, they went down, but the way it's working is the solution of the Fed creating all this money is the sole reason why the markets kind of turned around after reaching a very low point in the middle of March, because they're seeing that money is coming their way. And so if money is coming their way, it's going to elevate the stock market. People are going to start to talk about that again. And that's a dislocation from the real economy. And so we're going to get further and further away. And then we're going to have another crisis. And at that point, once we get through this one, the Fed creates all sorts of multiple trillions of dollars to continue to do this now, that it will just continue to happen again. This is the problem. The problem is it doesn't end because there is no limit, and the money isn't used in a proportional way that benefits the real economy from sort of the foundation up.
No, I mean, there's got to be a reckoning. You can't have a house of cards like this and not have a reckoning.
Well, now, you're going to have some corporate bankruptcies. But the problem that's occurring, I believe, that will occur first, is that it's going to be some of the smaller ones that don't have access to enough money to keep going, or to sort of retool their employees when they have the chance, all of them, that they had to let go. And at the bigger companies who have these relationships with the Fed and their own banks who have the relationships with the Fed plus the relationships they have with Washington, and so forth, receive the benefit, and they don't do the bankruptcies. And it's not like we want all companies to go bankrupt, but the point is they get a disproportionate piece of the pie, and people don't. And what that means is the next reckoning, if you want to call that, is a fall from a higher height. I mean, this is what I was talking about in the end of my last book, in the end of Collusion. It was literally like, we have a situation, it's the last page of this book, and I'm not saying this to pull my book, it's just, this is what was so obvious. Companies had all of this cheap money that was manufactured, to banks, from the Fed, through banks from the Fed, and they used it to buy their stock. Banks use it to buy their stock. They used it to, pay dividends to people to inflate their stock. They used the stock to inflate their, their compensation. They didn't put enough away in reserve for an emergency, whatever the size of that emergency. It's just even anything. And anything that could have been enough that they could have used and pointed to and been like, look, we've got some of this. That did not happen. And so as a result, and I said this in the book as well, you were going to get a point, there was going to be some external thing that was going to happen, and all of that borrowing, all of that cheap money and zero and low interest rates that allow companies to borrow and buy stock and borrow and buy stock and borrow and buy stock for literally no cost to them, because interest rates were so low to them, was going to cave. And that's what we saw when the 35% market drop, that all caved. The sort of value of their credit, of their debt caved. Then the Fed comes in and says, no, we're going to scoop up the bottom. And so now we're sort of back in the same, sort of negative cycle.
This thing's going to blow. I don't know when.
It's going to happen. It's going to, it's already happening again. It's already happening again, and we're not out of this phase.
Last time I gave the analogy of the housing market was the trigger. The derivative bets that they made on top of those mortgages were the gun, right? Yeah. So in this case, even bigger picture, I think that the next crisis, either this one or the next one, could be the trigger. But the gun is the Federal Reserve buying endless amounts of assets.
Yeah, and everything.
That's going to create a catastrophe and a Great Depression like nothing we've ever seen before. That's worse than any of these individual crises.
Yeah, no, it's like that third time problem, the sort of negative charm. We failed to figure out what to do last time. We made it worse into this particular crisis, with respect to the Fed, with respect to the risk that's taken on in the system, and then other people actually, fall under the weight of the problems that then happen. And now we're recreating it to be just a bigger problem. And I do think, first of all, it's going to take a while to get out of this phase. But I do think the next one is going to be even bigger, because that's what's been happening. Each time we don't learn from the last time. And each time we're basically, facing a fall from a just higher height of debt, of derivatives, of sort of, the creation of money against no value, to supposedly solve things that doing that doesn't solve.
Yeah. All right. Nomi, Prins, one of the top experts in the country on this. Definitely check out our book, Collusion, where you'll see that reference that Nomi was talking about, and get a full picture of how these crises happen and who takes advantage of them. Nomi, thank you so much for joining us on the Young Turks. Appreciate it.
Thank you.
The TYT Plus app is now available on iOS and Android. Download to get more TYT content at tyt.com/app.